is a mortgage? What is SVP? What is LTV? There's lots of jargon that people use in any industry. And I think in the mortgage industry or as a mortgage broker, there's lots of jargon. And quite often people feel uncomfortable asking questions because they figure they should know the answers to these questions. This is one of the reasons why I provide so much content explaining concepts that seem simple and basic to people that understand it. But to everyday home buyers, these terms can be confusing. My name is Anthony Lindsay, and in today's video, I'm going to explain some of the terminology that's used in the mortgage industry. I'll also answer some of the top questions. Make sure you watch all the way through, you like, you subscribe, and leave comments. And if you're a mortgage broker and you see another way of explaining something, I'm happy to take your feedback, happy to take your comments. I love answering people's questions and I love explaining the mortgage process. I've been in finance for over 30 years and it's something that I not only like, I love because I have the unique opportunity to help people find a new home or maybe purchase additional homes to add to their portfolio. My name's Anthony Lindsay. Now, a few things might surprise you, or maybe they won't. But one thing that I know about every property purchase is that everybody has a secret. So the buyer won't disclose everything, the seller won't disclose everything, and the estate agent, solicitor, and the broker are all just trying to do their job to get the best outcome for whoever their customer is. The estate agent works for the seller. So, a common mistake that a lot of home buyers make is that they think that the estate agent works for them. Wrong. The estate agent works for the seller. Their job is to make sure that the seller gets as much for the sale as possible. And that's good and that's noble. But as a buyer, you need someone on your side, and your mortgage broker works for you. Your mortgage broker's goal is to get you the very best mortgage that you can afford based on your circumstances and what you're trying to accomplish. I always tell people the whole process is as fast as the slowest person, but one thing I know for sure, it takes longer than you think. Unless you're buying from auction where there are very strict timelines, the purchase process is usually going to take 4 to 6 months. I'll go into that in a little bit more detail after, but don't think that you're going to go out, find a house in a weekend, make an offer, get it accepted, and be moving in the next month. It doesn't work like that. And for some people, they need that additional time to build up their deposit. But understand that the mortgage process is going to take 4 to 6 months, and it can take even longer if there's a chain involved. Another thing to consider is that it usually ends up costing more than you budget for. I've worked in finance for over 30 years and I've done debt collection, I've done lending, and I've done mortgages. And one of the things that I've noticed is when people are looking to get a loan, they always overestimate their income. So they round up. When people can't afford to pay anymore and they have to fill out forms to reduce their payments, they always underestimate their income or they round down. But the bottom line is if you're purchasing a property, the numbers that you're given are usually going to end up being a little bit more. And that's not intentional. It's just because quite often things take longer or we may run into complexities that we hadn't anticipated. So when you're talking to your solicitor will give you some set costs, but they don't know what issues they'll run into while they're doing the mortgage for you or while they're helping you with the purchase. And so it may cost a little bit more. The home purchase, don't forget there's additional fees and there's additional things and expenses that you'll have to invest in when you get your new home. Everyone has a secret. As I said, the seller will not disclose all of their information. Buyers want to get the very best price. And me as a broker, your solicitor, and your estate agent are always doing their best to make sure that they get you the best outcome. It does take longer than you think. And here are some of the timelines. First, we'll look at a purchase. So if you want to understand how long it takes to purchase a new home, I would give you a guide timeline of 4 to 6 months. And that's from the moment that your full mortgage offer has been issued by the bank. Before that, there's lots of things that need to happen. But from the moment your full mortgage offer is issued from the bank, it's usually going to be about 4 to 6 months. So, what I try to do with my clients is prepare them for the wait, give them other things to do while they're waiting, but make sure that they understand that the process has to be played out in a very specific way. So the solicitor is going to be making sure that the searches are done. They're going to be looking through the deeds. They're going to be making sure that the property that you purchase on paper is sound. They're going to make sure that everything is in place, that all the T's are crossed and all the I's are dotted. And that can take a while, particularly if you're dealing with a solicitor who maybe doesn't have the capacity to deal with a lot of clients. So, this is why it's so important that you select the right solicitor. That 4 to 6 weeks will also include some things that are out of your solicitor's hands, such as searches. I've been doing a lot of right to buy mortgages recently, and some councils are super fast, other councils are super slow. So, when it comes to searches and when it comes to the seller's solicitor, a lot of that is out of the hands of your solicitor. So you need to make sure that you keep them up to date with what's going on with you, that you have sufficient updates to understand what's going on with your case. As a rule of thumb, I suggest if you haven't heard anything from your solicitor in about 2 weeks, that you should just touch bases with them. Many firms have a online dashboard that you can go into and you can send and receive messages. It will also give you the progress of your case. But if you've had no progress in about 2 weeks, I would say just reach out to the solicitor. Just make sure that everything is on track. A good law firm will always make sure that you're up to date. You know what you're waiting for, you know what is outstanding, and you know what the next few steps are going to be. Chains can take even longer. So a chain, because this is one of those bits of jargon, a chain is a situation where, let's just say, you are purchasing a property, but the home that you're buying, the person that is selling that home needs to buy another home in order to be able to sell. A chain can go on because you could have multiple people in that chain. This is why a lot of sellers prefer first time buyers that don't have to sell a property in order to purchase, because this can make things a lot smoother. So, one of the problems with a chain is, let's just say you, person A, you're trying to buy from person B. Person B, in order to sell to you, needs to purchase from person C. If any person in that chain has an issue or has a delay, it slows down the whole process. So, as a buyer, make sure that you're asking the question of the estate agent, is there a chain? For some people, that's a good thing, because let's just say you're a little bit short on your deposit and you need a couple more months in order to get that deposit together, then a chain might be good, especially if your savings is in a high interest savings account. Every month that you're waiting, you're gaining interest. I'm not giving tax advice or legal advice. Make sure that you speak to an accountant about the implications of getting interest on your savings. But a chain can be a good thing or a bad thing. But in most cases, people are looking to buy, move into the new property, and start their new life or the new season of their life. So it's important that you consider, is this property that you're looking to purchase in a chain? And if so, what are the implications of that? And how could that impact the length of time that it's going to take for you to buy your new home? Another timeline that other people ask about is a remortgage. Let me explain what a remortgage is. I was speaking to a client today who is, a first-time buyer, very intelligent individual, and she said, "Anthony, could you just explain what a remortgage is? After I buy this property in X amount of years, when my fixed term ends and I want to remortgage, what exactly is that?" She even asked me about what happens when she sells. But let's first talk about a remortgage. So when you're taking out a mortgage, there's two terms or periods that we look at. We look at the overall term. So that's usually the long number. That's the entire time that it would take, and we're talking about repayment mortgages now. That's the entire time that it would take to fully pay off your mortgage. So let's just say you take out a mortgage with a term of 30 years. That means from the moment you get that mortgage, over that 30 years, you'll pay down the mortgage. At the end of 30 years, you'll have a zero balance. You'll own the property outright. Wow, that's a great feeling. But within that, most people will have what's called a fixed period or a fixed term or a benefit period. This is usually 2, 3, or 5 years. You can do it 1 year, a 5 year, a 7 year. There's other ranges, but most products are grouped at 2 years, 3 years, and 5 years. I like to talk about it as short, medium, or long term. Why would someone take a 2 year fixed? If you feel that the interest rates are going to be going down in the short term, then quite often you would want to get a short fixed period. The great thing about the fixed period is that you know how much you're paying every single month for that fixed period. However, there's something called fixed rate risk. So the fixed rate risk essentially means if you do a longer term, let's just say you do a 5 year fixed rate. On the upside, you know exactly how much you're going to be paying for the next 5 years. However, if interest rates drop within that 5 years and you want to take advantage of that, you're unable to unless you pay an early repayment charge. So, yes, you can fix it. And when you're speaking to your mortgage broker, quite often they'll give you some guidance. But always remember, none of us know what the future will hold. So, we can give you some guidance. We can tell you what other people are doing. And potentially, you might find that a 2 year fixed is less expensive than a 5 year or vice versa. But ultimately, you need to decide what you want to do. We will advise. 2 years can go really quickly. So for some people, they say, you know what? I'm willing to take the risk and do 5 years because you move into your property and before you know it, you're looking to remortgage, which is what we're talking about right now. So at the end of that fixed term, whether it be 2, 3, 5, or another range, at the end of that term, if you have a fixed rate, that fixed rate ends and you go on to what's called a standard variable rate or SVR. The standard variable rate is exactly what it says in the name. It's variable. So at the end of that fixed term, you will go on a standard variable rate. When you go through your illustration document, it will give you a guide of what it would look like, but that's a little bit misleading because nobody knows 2, 3, or 5 years from now what the rates will be, and therefore you don't really know what the standard variable rate would be at that point. So most people at the end of the fixed term, they look to do something called remortgage. So that means you have if you remember the original illustration we went through was, I think it was 25 years. So you took out a mortgage with a term of 25 years. Let's just say you took a 5 year fixed. 5 years from then, you would, in theory, have 20 years left. However, when you remortgage, you are starting a new mortgage to a degree. So, what you could do is you could remortgage and do it over another 25 years. You could do it over 10 years. You can adjust the term when you remortgage. The great thing about remortgaging, especially if you've had a large deposit and or your property value has gone up, so you have additional equity. And remember, equity is the difference between what your house is valued and how much you owe. If you have additional equity in your home, there's lots of things that you can do. You could release some of that equity, which is a further advance. You could go on to a new mortgage, but now because your loan to valuation may put you into another threshold, you may find that your payments are considerably lower. There's so many things you can do, but just view the remortgage as kind of starting over, but you've already gone through the process once. So one of the things that you want to consider when you're thinking about potentially remortgaging, always go to your existing lender first. What will usually happen is 3 to 6 months before your fixed period ends, your current mortgage lender will send you a letter saying your mortgage is ending in X amount of months. This is what we can offer you. So look at that figure. That's the figure that you will take to a mortgage broker or bring to me and say, look, my current lender is offering me X. That way we can explore and see if we can do a better deal for you. But remember, when you remortgage, if you go to another lender, then you're going to have to go through the process all again, and that might be tedious. And this is why you have to consider, have your circumstances changed? Let me explain what might be really positive for you, especially if you're someone that had to go to a specialist lender to get your initial mortgage. Let's just say you had credit issues or late payments, missed payments, something that prevented you from going to a main street lender that's offering the best rates for vanilla clients. If at the point of remortgage, you've paid your mortgage well, you've never missed a payment, you've managed your finances really well, you may find that now you qualify with one of the high street lenders because initially you had to go to a specialist lender due to credit issues. So now, when you're looking to remortgage, it might not be in your best interest to stay with the current lender because they're a specialist lender. So they are people that help people get back on track due to credit issues or other circumstances. So in this case, you might find that by going to another lender, you're going to get a better rate. And if the rate is considerably better, it may mean that you can reduce the term on your mortgage or you can release equity. There's just so many things you can do. So always first see what rate your current lender is offering you, then speak to a mortgage broker and consider, have your circumstances changed? The opposite could be true as well. It could be a circumstance where initially you had good credit, but now you have missed payments or things of that nature. In that case, you may just want to stay with the same lender because you might find that other lenders aren't going to do the remortgage for you. So that's a quick overview of what a remortgage is, why you might need or want to remortgage, or why you might consider staying with the lender that you. Either way, make sure you speak to a broker. That broker will be able to give you good guidance, good advice, and compare the market for you. So the benefit of going to a broker is you're not just talking to one lender. Brokers have access to all the lenders, different products, different services, and can cater the lender to your needs. Okay, what is a product transfer? So people quite often ask, what is a product transfer and how long does it take? So a product transfer is essentially when you keep the mortgage that you have with the lender that you're currently with, however, you switch to another product. This could be for a range of reasons. One of the main reasons someone might do a product transfer is because initially when they got the mortgage, maybe they had some credit issues or something that's happened that prevented them from getting the top tier product. Quite a lot of lenders have different tiers for different profiles. So you may have initially been on one of the lower tiers, meaning that you didn't qualify for the best offering from that lender. But 2, 3, 5 years in, you've done everything right. You've paid your mortgage on time. You've paid down any outstanding debts. You now have a fixed term permanent job. You've become more of a vanilla client. So you don't need any specialist type of products or services with that lender. So you could transfer to another product, but with the same lender. This is quite often a lot easier because the lender already knows you, they have your details, they have the property value. This is why a product transfer is a lot quicker than doing a remortgage or doing an initial mortgage. This can take 1 to 2 weeks. But as with everything, it's always going to be dependent on your responsiveness. Quite often, a lot of the delays that people experience when getting a mortgage are down to them. I've had clients that have called me after being referred by an accountant. And by the way, I get a lot of referrals from accountants. If you're an accountant, make sure that you shout me out. But I get a lot of referrals from accountants, and quite often it's because that person is struggling to get a mortgage for whatever reason. I've had clients call me and say, listen, my accountant, John, referred me over to you. We heard that you're great. I'm desperate. I need to get a mortgage. I found a property. They're willing to sell to me, and I now need an agreement in principle. I'm the type of person that always says this to my clients. Be aware that I work really fast. I work really fast. So I'll never rush my clients. I'll never rush them to move faster than they are capable of moving. But my philosophy and the philosophy at our firm is it's okay for the client to wait on us. It's okay for us to wait on the client, but the client should never be waiting on us. So that person comes to me. I say, all right, here's the checklist. I need 3 months pay slips, 3 months bank statement, proof of identification, a printout of your credit report from checkmyfile.com, ID, proof of deposit if it's a first time purchase, etc. I'll send that all over within 15 minutes of having the initial phone call. And then it's tick, 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 tick. I've had clients just disappear for 2 or 3 weeks, and that's what's delayed the deal. So that's just a cautionary tale. When you're speaking to a broker, I would like to think that everyone tries to move quickly. Not everyone might be as fast as me, but I'd like to think that we all move quickly and we're all trying to get the best results for our clients, especially when they're in a situation when they need things done quickly. But if you don't send us the documents that we need, we can't do the things that we need to do. So that is a product transfer. The top questions that I get asked before or during a mortgage. The top questions are, what is the best rate? The rate question gets asked all the time. People often ask, what is the best rate? And it's really difficult to answer. And sometimes people might think the broker is being evasive, but the bottom line is, what's the best rate for you? So there may be an amazing headline rate out there. However, you don't qualify for it. The best rates are reserved for the best clients. And if you go directly to a lender, this is why you should always go to a broker. If you go directly to a lender, they may be offering you their best rate. So that might be the very best rate, very best product they have. But it doesn't necessarily mean it's the best rate, because you might find that other lenders, because mortgages are very competitive, you might find that another lender has a better rate. This is why, as a mortgage broker, I will always say, well, what are your circumstances? I'll understand the needs and maybe some of the limitations of the client. We will then go through the criteria that you meet. We'll go through your pay slips, your income, make sure that it's structured correctly. Then we'll do a Zoom call and I'll go through everything visually to show you what's out there, what the rates are, what the monthly payments are. So I would advise people, instead of just focusing on rates are important, but focus on the monthly payments, focus on having a mortgage that is affordable to you. Because the rate conversation can be misleading. Right now, we have, within the next year and a half, millions of people that are going to be coming off a really low rate of like 1.x, 1.9, 2%. Because at the time they took their long fixed rate mortgage out, the rates were really low. So anything is going to be a huge increase to them because the rates are higher than they were at that time. Conversely, Prior to the rates dropping, people who were on interest rates starting with a 4 or a 5, when the interest rates dropped and they went to remortgage and they saw interest rates at 2% or 1.8%, that was an amazing and could be life-changing rate reduction. So rates are important, but just make sure that you select the right fixed term and make sure that you select the right product and the right monthly payments to match your budget. When do I pay the deposit? When do you pay your deposit? So your deposit is going to be required, or proof of your deposit is required at the very beginning of the mortgage process. They will ask for a bank statement. If you're getting a gift from someone else, so like if you have a parent or someone's gifting you some money towards your deposit, you may not want to ask for the money before you need it. And lenders will understand that. But in most cases, you're going to need to provide proof of your deposit. I've done a lot of videos on what lenders want to see. One thing they don't want to see is lots of money coming from random places on your bank statement. So as you build up your deposit, make sure you put it in a high interest savings account that's producing some interest for you. The best way and the cleanest and easiest way to be able to demonstrate where those funds come from is when you get your salary paid into your account, you transfer from your account into this savings account. You're probably not going to get the best interest rates on your current account. That's why it's important to go to Money Saving Expert and find a good savings account that's going to give you a great rate of interest. But the actual deposit doesn't come out of your account until almost before you get your keys. So it will sit in the account until that point. And do keep in mind that if you have like a lifetime ISA and some other types of savings products, the money that you have in there is not paid to you. It goes directly towards the purchase. So I've had clients who have had ISAs or lifetime ISAs that they're going to use that money towards their deposit. It's not money that is then given to you. That money is used for the purchase. So just keep that in mind. What is the difference between a valuation and a survey? Great question. The difference between a valuation and a survey is this. The valuation is for the lender. So the lender, in any case, when they're doing a mortgage, they need to know how much the security property is worth. So the purchase property, they need to know the price or what they feel that it's valued at. So they'll do a valuation. In most cases during the mortgage process, when we're doing the full mortgage application, we'll order a valuation. Sometimes you have to pay for the valuation. Other times it's one of the incentives that comes with the product. But the valuation is for the lender. There's three outcomes. You could come in at value. So the purchase price aligns with what the lender thinks the property is worth. It can come in above value. They might say, well, you're purchasing it for 400,000, but we think it's worth 420,000. Great news. However, you have a problem if it comes in under value. If let's just say you're buying it for 400,000, but they value it at 380,000, that's a problem. I do have a video on that. Make sure you look it up. So there's going to be three things. So the valuation is for the lender. It's done in every instance. You may need to pay for it. It may be free. A survey is something different. A survey is for you, the buyer. You want to know more about the property that you're purchasing. You want to understand if there's some issues or there are some structural challenges that might cost you a lot of money. You want to know that in advance. That's why you would get a survey. So you'd get what's called a RICS survey. You can find RICS qualified surveyors online. Some lenders will offer the survey as part of the purchase process. You do have to pay an additional amount for it. Make sure you do your research when you're getting the survey conducted and you're selecting a company. They're all qualified professionals, but as with any qualified professionals, you will get different levels of service. So the key difference between evaluation and a survey is the valuation is a required part of the mortgage process. The lender wants to know how much the property is worth. A survey is an optional bit that the purchaser may choose to decide to get a survey done. What if my mortgage offer expires? So let me quickly explain the mortgage process. First and foremost, you speak to a broker. So you'll come to me, we'll do an affordability assessment. That will enable me to do an agreement in principle, AIP, or a decision in principle, or a mortgage in principle. This is not a mortgage offer. It's not a binding contract. In most cases, the AIP, or agreement in principle, is going to be valid for 30 days, 60 days, 90 days. It will say on the document. But that agreement in principle has not been underwritten, meaning we've entered information in the lender's website to say these are the figures. They haven't asked for pay slips or bank statements. They've done a light credit search, and a lot of times it's not a full credit search, just to see if on a cursory view, if you look like you would qualify for this product. The lender then does the agreement in principle. So you now have the agreement in principle. You go out, you look for a home, you negotiate the price, you get the seller to agree a price to sell it at that you're happy to purchase it at. And then you come back to me. We put all of those property details in, because remember, an agreement in principle is against you, the individual, or the couple. It's against the person purchasing the property or people purchasing the property. So it's based on you. A mortgage offer is based on the property. So when you're getting a mortgage offer, they're going to ask for the property details, because you might find that the lender is more than happy to lend to you as an individual. However, the property that you're looking to purchase may have issues, or they may not want to lend on that. This is an important distinction. So you may have an agreement in principle. The lender may be willing to lend to you, but when you find the home, they may not want to lend on that specific property. But let's just say you go through the underwriting, they do the credit checks, we send them all of your documents, they're happy with the documents. They do what's called a full mortgage offer. The full mortgage offer will detail the interest rate, the monthly payments, everything about that mortgage. It's 8 pages. Make sure you read it thoroughly. Make sure you understand it thoroughly. Make sure you go through that mortgage offer with your mortgage broker. There's a couple of great things about a mortgage offer. It does solidify the offer from the lender. It has a end date, so they might say, well, this offer is good for the next 6 months. That's great. That protects you from any rate increases. So within that period of time, if they remove that product, or if the interest rates go up, you're protected from that because you have that mortgage offer. However, if rates go down and you're dealing with a broker like me, we will be able to put you on that lower rate with your permission. So the mortgage offer is great because you know what you're working with, and it starts the purchase process. However, it does have an expiration date. So let's just say your mortgage offer expires in 6 months. And like what happened to me today, my client called me and was like, the solicitor's telling me that the searches are taking a long time. So what happens if my mortgage offer expires? We just go back to the lender and let them know that it's taking a little bit longer. Now, in most cases, they'll extend the mortgage offer with very little need for any additional paperwork. Sometimes they'll rescore the account. This is why it's so important that during the mortgage process, you behave yourself financially. So don't go out and get credit cards or get loans or do anything that would impact your credit. Now, you do want to pay down loans or pay off credit cards, but if you've been approved for a mortgage based on a specific affordability, if you go out and get more loans and more debt, that will impact your affordability. So when you go to get that mortgage offer extended, if they do a new credit check, then it may mean that they're unable to give you the extension. And this also goes for your job. Like, it's not a good idea to change jobs during the process. It's not a good idea to do anything that is going to impact your ability to be able to repay your mortgage. But in short, if your mortgage offer expires, you can get it extended. Just make sure you reach out to your mortgage broker and they'll be able to do what is needed in order to get that extended. How do I prepare for a mortgage? I'm going to talk this through really quickly. And if you do these things, it will give you the best chance to get the best rate and the best product that you qualify for. And it's always about what you qualify for. You've heard me say it before, and I have tons of videos that cover this off. Make sure that you check your credit report at least once a year. I would advise twice a year. And we always recommend, and we require if we're doing a mortgage for you, that you go to checkmyfile.com. Download your Check My File credit report, review it, make sure that everything is as it should be. Do this before you apply for your mortgage. And you know what I'm going to say next, right? Make sure you speak to a mortgage broker at least 6 months before you think you're ready to get your mortgage. The reason this is because if you look at your credit file and you find things that aren't supposed to be there, or someone has registered something that's on that they shouldn't have registered on your credit file, it may take a couple months to get that resolved. And your credit profile, not just your credit score, but your credit profile will determine what products you qualify for. So if you have a unsatisfied CCJ, or if you have missed payments that weren't actually missed on your credit file, it may take a month or 2 months or 3 months to get that resolved. So if you speak to a mortgage broker 6 months before you think you're ready, we can go through all of the details with you. We can look at your pay structure. We can look at your bank statements. We can do all of these things to make sure that you're prepared, that when you apply, any silly things that could be cleaned up are cleaned up to get you the very best product. Speaking of tidying things up, make sure you tidy up your bank statement. So as someone that's worked in finance for over 30 years, I used to work as a bank manager. And quite often people would come into the branch and speak to one of my staff with a printed bank statement and point at something and say, "What's this?" As if we in the bank sit and just look through people's bank statements. The reason why I say that is on your bank statement, you might see some things that you forgot about. Quite often we sign up for these things and it's free for 30 days or free for 14 days, but you have to cancel it. We forget to cancel it. And because we're just flush with cash and we don't review our bank statements, it could be, a $9.99 subscription that you've been paying for the last 8 months or 9 months. All of these things add up. It could be something that's on your bank statement that's going to impact your affordability. So go through your bank statement, look at your standing orders, look at your direct debits, review your insurances, review things that you're paying for. Because, for example, a lot of bank accounts have what's called packaged accounts. So it may come with mobile phone insurance or breakdown cover. So you may already be paying that. But then when you look on your direct debits, you see that you're also paying for that service through another provider. So tidy all these things up. Don't put silly transactions on your bank statement. I always tell this funny story. I had a client who came in, I was doing a mortgage for them, and they had loaned someone some money. And in the reference, they put something silly, something, is a young guy. He just put something silly. And when we were doing the mortgage and we sent that over and the lender saw that reference, they queried it. So things like that. Make sure that you are managing your bank statement well. Make sure that your direct debits that you no longer need are canceled. Make sure that you have a good grip on your finances. If at all possible, make sure that you're not using your overdraft. Stay in credit. Make sure that your salary is paid into your current account that you're going to be producing, because from a bank statement perspective, anything we see on there as far as transfers or deposits, we may need a bank statement to support that. So if you're like me, I have 3 bank accounts, and I have one that my salary goes into. I have another one that I use for my daily expenses. And then I have a third one that is just, I just keep money in there. Quite often when doing the mortgage process, they're going to need to see 3 months of all 3 bank statements. So if you don't need the additional accounts, then just close them or combine them, or just make sure that your bank statements are tidy, easily read, and they make sense. Check your employment contract. I don't think I've ever talked to somebody and gone through their finances, asked them about their work benefits or their death in service, and they completely just know what it is. Most people don't look at their contract beyond signing it and starting their job. The reason why I say to look at your contract, are you fixed term? Are you permanent? Are you a contract worker? All of these things will impact your ability to get a mortgage. It won't prevent you, but it will mean that certain lenders might need additional things. Are you paid through an umbrella company? That's another thing. These are the things that your broker is going to need to know to match you with the very best lender. So look at your contract, understand your structure, if you're full-time, if you're part-time, if you're permanent, if you're temporary. This way you can discuss these things with your broker. Maximize your deposit. So make sure that your savings towards your property purchase is in a high interest savings account. Make sure that the funds that are in that account, it's easy to track and trace how that money was built up. So you got paid £1,000 into your current account, you transfer £200 into your savings account. It's clean, it's easy to track, and it will help you save the money quicker, and it will make it more visible. But by having a high interest savings account, it just means that your money is working for you. As I always say, speak to a mortgage broker. Don't speak to your barber or your cousin Ray Ray or your beautician or the lady doing your nails or the guy in the line in front of you at Tesco's. Speak to a mortgage broker. We are licensed professionals. We have a lot of regulation that ensures that we're going to do the best thing for you. Our job is to make sure that you get the best product over the shortest term on the best rate within the criteria that you're looking to get your mortgage. So speak to a mortgage broker. Most mortgage brokers are going to be more than happy to have a conversation with you, answer your questions, even if you're not ready to purchase now. So it's important that you speak to a mortgage broker. And it's also very important that you're honest with your mortgage broker. If you're speaking to a mortgage broker and you don't trust them enough to tell them the truth, then you shouldn't be working with them. Only work with someone that you trust. So you may need to get a referral from a friend or family member who has worked with that broker recently, not 20 years ago when they bought their first home, but someone who's worked with that broker recently. Check the reviews, ask questions, make sure that you feel comfortable before you proceed. But once you start the process, make sure that you're transparent with the broker. Because there are specialist lenders to meet every need, there's no need to be dishonest. And lenders don't want people that aren't being transparent. There's something called disclosure. A bank would rather know that you missed a payment than you say you don't have the account and then they pick up that you have an account. All right. So just make sure that you're honest. It will also speed up the process, because one of the things about being a broker that I absolutely love is the more you do it, the better you get at it. And you get that muscle memory. And now I'm speaking to a client, and as I'm talking to them in my mind, I'm able to say, well, yep, this is good for this lender. This is good for that. And by the end of the conversation, in my mind, I probably have a list of 3, 4, 5 lenders that I know I can take them to. Then I get the documentation, I verify it, and then we just go and look at the lender's specific criteria. If we're not sure, we can speak to a business development manager. But none of this is possible if you're not honest with your broker. Even if it's something that you're not sure will make a difference, make sure you tell your broker, because if it's not going to make a difference, then they'll tell you. If it is going to make a difference, it's better for us to know in advance. My name is Anthony Lindsay, and I'd love to be your broker. If you don't need a broker, then I'm sure you know someone that does. You can scan the QR code. You can reach out to me. I do something called a mortgage affordability assessment. I do it completely for free, no pressure, no selling. And mortgage affordability assessment will let you know how much you can borrow based on your circumstances, with no credit check, no pressure. I'll simply use my 30 years worth of knowledge, ask you some questions to get a guide on what your income is, what your credit profile looks like, how much you have for a deposit, and where you're looking to purchase based that's that I can understand what the property prices are. And then I'll be able to tell you, well, look, this is the likelihood that you'll be able to borrow this amount. I'll also be able to tell you what the stamp duty might be if you have to pay stamp duty, give you a guide on what the solicitor's fees are. So you can take that information and maybe you need to go away and come back in a couple of months, or maybe you're ready now. But either way, I do a complimentary mortgage affordability assessment. Just make sure you reach out to me. And if you have any friends or family members that are looking for a mortgage, make sure you like, share, and comment on this video. And I will make sure that I continue to provide quality content, explain things in a way that you can understand. And I always welcome your feedback and your referrals.